TradingView recently introduced a completely new type of chart, which is called high and low. It is a very interesting concept that can help a lot of price action traders analyze the charts in a totally new way. And this of course might lead to more accurate trade entries and exits, which is definitely something everyone is looking for. So in today's video, I will explain in detail how to read the high and low chart and share some of the best price action strategies with it. Let's begin. Okay, so before we apply the high and low charts, let's actually take a look at the regular Japanese candlesticks and spot some of the main problems with it. So the problem number one, Japanese candlesticks can be quite difficult to analyze if you're a beginner, especially when you have a lot of candlestick patterns to learn, such as spinning top, hammer or a shooting star. The problem number two, the colors of the Japanese candlesticks might give you the general feeling of where the market is heading to, however this works only in a trending conditions. Notice when the price action is trending in a bullish direction, the candlesticks are mainly green. Hence, when the market starts moving in a bearish direction, the candlesticks are mainly red. But as soon as the market starts chopping around, which happens around 80% of the time, we see the candlesticks are literally mixed up. This is definitely not helpful and it creates a lot of confusion. With that being said, we definitely need to have an alternative type of chart that would solve these problems. And luckily, TradingView finally introduced it. In order to apply it to the chart, we need to first click on a candles tab and then select the high and low. As we can see, the chart looks much more simplified and there is less noise going on. You can customize the look of the chart by double clicking on it. You can change the color of the body, borders and labels. I personally like to keep them white and green. If we zoom in, we can see that each candlestick displays the high and low prices that happened during this time period. The bars are built based on the value of the maximum and minimum prices for a given time frame. As we can see, there is no open or closed prices. Instead, you see the range in which the value changed on the time frame. There is also no colors, which can definitely be an advantage because you're literally trading in a neutral state of mind. The chart might look a bit weird at first because you're not seeing the open and close. But once you get used to it, you'll start analyzing the price action like a pro. Okay, now let's actually understand how to read these candlesticks. So when the high and the low of the recent candlestick is higher than the high and the low of the previous candlestick, market is in a bullish momentum. This means that the buyers are controlling the market. On the other hand, when the low and high of the recent candlestick is lower than the low and high of the previous candlestick, market is in a bearish momentum. This means that the sellers are controlling the market. As you can see, this is really easy to read the price action this way. You don't have any complicated candlestick patterns that you need to remember. There are actually only 4 of them, and now I'm going to show you which one they are. So the first candlestick formation is the bullish candlestick. It has a higher high and a higher low compared to the previous candlestick. Second formation is the bearish candlestick. Bearish candles have lower highs and lower lows compared to the previous candlesticks. The third type is the inside candlestick. It has a lower high and a higher low compared to the previous candlestick. Even if the high or the low are equal to the previous candlestick, it's still considered as an inside bar. And the last formation is the engulfing candlestick. This type of candlestick has a higher high and a lower low compared to the previous bar. So these were the 4 types of formation: bullish, bearish, inside and engulfing candlesticks. Now you might be asking, how do we actually trade with this type of chart? Before I show you the actual trading strategy, you need to understand a few rules. First, when a price action forms consecutive bullish candles, the market is in an uptrend. Second, when the price action forms consecutive bearish candlesticks, this is a sign that the market is in a downtrend. A strong bullish candlestick confirms the start of an upswing, and at the same time it indicates the end of a downswing. A bearish candlestick indicates the end of an upswing and the start of a downswing. The inside candlesticks are usually neutral bars, and they do not affect the overall trend direction, because there is typically indecision going on. Engulfing candlesticks, on the other hand, introduce an uncertainty. But if these candlesticks are formed after a major upswing or a downswing, the price action is more likely to continue to move in the same direction. Notice a bearish candlestick that changed the direction of the trend was formed. Then we had a few consecutive bearish candlesticks that indicated a downtrend. The market entered in a small consolidation zone, and then an engulfing bearish candlestick was formed, which indicated a continuation downtrend. Exactly opposite is true when the market starts moving in an uptrend. We see a strong bullish candlestick must be formed, then we have a few consecutive bullish candlesticks that indicate an upswing. After that, the market starts consolidating, we see that we have some neutral candlesticks, and then a massive engulfing candlestick is formed. And as we already know, this usually leads to a continuation trend. There are multiple price action strategies that you can use with this type of chart. You can start, for example, with the most simple one. For this strategy, you need to find the major levels of support or resistance. If we take a look at this chart, we can see that the major level of resistance is at around $86. We can see that the price action bounced off of it a few times. So to confirm a short entry, you're going to be waiting for a few consecutive bearish candlesticks. Here we see that the price action is making lower highs and lower lows. You can place your stop loss slightly above the level of resistance. In terms of take profit target, you can set it at 1.5 or 2 times the risk. For long positions, you want to find the major level of support. We can see that it's sitting at around $86, and then once you identified it, you're going to be waiting for a few consecutive bullish candlesticks. The stop loss will be set slightly below the level of support so that you don't get stopped out. As we can see, the market immediately hits that take profit target. You can also use a pullback strategy with this type of bars. So here we have a 50 and a 200 EMA. So to enter a long trade, you're going to be waiting for a golden cross first, where the 50 EMA crosses above the 200 EMA. Then the price action has to pull back into the 50 EMA. And as soon as the engulfing candlestick is formed, you're going to enter a long position. Obviously, you do not enter a long position if the price action crosses below the 200 EMA. This usually indicates a start of the ranging market. Exactly opposite is true for short trades. First, the 50 EMA has to cross below the 200 EMA. Second, the price action must pull back into the 50 EMA, and then it has to form an engulfing candlestick. As we can see, this particular candlestick has a higher high and a lower low. To increase the win rate for the strategy even more, you can add another confirmation indicator such as RSI or Laguerre RSI. The rules are pretty much the same except for the fact that the RSI has to get overbought first before you enter the trade. Okay traders, I hope you have understood the concept behind the high and low charts. Make sure you leave the like button if you found the video useful. By the way, if you want to see more price action strategies, check out this playlist right here.